Hello and welcome to Pest Control Unlocked. My name is Konstantin Schwartz. It is earnings season and the deep dives into Rollins and Ecolab have already been covered. Today we're taking a closer look at what Rentokil brings to the table. And the first thing they did was to take something off it. 20% operating margin in North America by 2027. That commitment survived 3 chief executives and about 8 quarters of analyst questions. On the 30th of July, they retired it. Not because they missed. In the same set of results, North America Pest Control Services came in at 19.7%. They were basically there, and they walked away anyway. So that's the question for the next half hour. Why give up a target you're about to hit? Before we start, some housekeeping first. Nothing in this episode is financial advice. I'm not a financial advisor, and I'm not offering you one's opinion. If you're making investment decisions, go and talk to a licensed professional who knows your situation. This show is for educational and entertainment purposes only. Everything I say here is my own view and nobody else's. I have no financial interest in any of the companies mentioned. I used to work at Rentokil. I don't own shares in Rentokil, Rollins, or Ecolab. Looking at the performance to start off with, group revenue came in at $3.6 billion, with organic growth of 3.6%. Operating profit $556 million, margin 15.5%, cash conversion 96%, and leverage down to 2.4 times, inside their own 2 to 2.5 target range for the first time since they bought Terminix in 2022. 4 years to get the balance sheet back. That's a real piece of work finished. North America is where the story is. Revenue $2.2 billion. Profit up 10.2%, margin up a full point to 17.9%, which looks strong until you split it. Business services, Steritech, distribution, lake management, mosquito, grew 10.6% organic. Pest control services grew at 2.6%, and it went backwards through the half, 2.8% in the first quarter, 2.4% in the second. Put the quarter next to it from the annual report. Fourth quarter 2025, 2.6%. First quarter 2026, 2.8%. Second quarter 2026, 2.4%. All of last year, Rentokil sold the market a story of steady sequential improvement, and it was true. The second quarter is the first one that isn't. Now the number to carry through the episode. Rentokil puts the global pest market at $29 billion, compounding at 6.6% a year for a decade, and forecasts 6.2% from here. Their own market data in their own results statement. North American Pest Control grew 2.4%, the largest operator in the world, in the largest market in the world, at about a third of market rate. Here's my take. Good half at group level, poor one where it counts. And to be fair about direction, because there is one, full year 2025 North America organic was 2.3%, this half 3.7%. Big step forward on that comparison. But the second half of 2025 was already running at 3.5%. Against the rate they finished last year on, this is 0.2 of a point up. The recovery is real. It's slower than the comparison they put on the slide. This is the center of the episode. North America contract revenue grew 2.6% in the half. By quarter, 3.0% down to 2.3%. Set that against what's written 3 pages earlier in the same statement. Pricing remains ahead of inflation, supported by rate card optimization and customer segmentation. And on the call, Paul Edgecliffe-Johnson said they're almost at the level of quite personalized pricing now. Rate above inflation, recurring book up to 2.3%. You run the maths on your own book every year, so you know what it means. The stop count didn't grow. Rentokil does not disclose the price contribution, so I can't prove it. This is the 2 disclosed statements put next to each other. It is an inference. But I'm not the only one drawing it. Edgecliffe-Johnson, same call, said, what we're not getting enough of is new customers. North America customer retention is at 80.7%. How they define that is worth knowing because it isn't how most of us measure it. In their annual report, retention is the total portfolio value of customers retained as a percentage of the opening portfolio. Value, not count. One national account leaving hurts that number far more than a handful of residential cancellations. Most operators track customer numbers. Rentokil tracks dollars. And those 2 figures can tell completely different stories about the same year. At 80.7% on a book running at around $3.5 billion a year, something in the order of $650 to $700 million of portfolio value has to be won back annually before the business grows by $1. My arithmetic, their inputs. That's why leads are up 6% and contract revenue moved 2.3%. Rentokil has a program for this. It's called Drive to 85. The annual report shows how it's going. At the end of 2024, 80.1%, end of 2025, 80.5%, first half of 2026, 80.7%. 0.4 of a point in a year, then 0.2. Run that forward, and Drive to 85 is somewhere between an 11-year and a 20-year program. I'm extrapolating 2 years, and programs can inflect, so take it as what the current rate implies. But Rentokil aren't arguing. Their own report calls retention a metric which is moving slowly. And one more, and I haven't seen anyone else pick this up. North American colleague retention is at 82.7%. Customer retention is at 80.7%. Rentokil now holds its people better than its customers. Colleague retention went from 79.4% to 82.2% to 82.7%, nearly 3 points in 18 months. Customers moved 0.6. Their international business retains customers at 86.1%. Same company, nearly 6 points better. There's a belief in this industry, and I've argued it on this show, that you can't hold customers unless you hold technicians. Rentokil is holding its technicians. The customers are still going. Here's my take. Retention isn't a service metric. It's the denominator under every marketing dollar you spend. And here's the practical version. Recalculate your retention the way Rentokil does it, by portfolio value, not customer count. If you've been losing larger accounts and backfilling with smaller ones, those two numbers will disagree. And the second one is the true one. Back to the margin target. They were nearly there. 19.7% in pest control services, up from 18.3% in 2024. That's 140 basis points in 18 months. Some serious operational work. So this is a choice, not a miss. The stated reason is reinvestment. Take cost out, put it back in, by volume rather than bank margin. Two things sit underneath. The first is just arithmetic. Business services grows at 10.6% on a 9.4% margin. Pest control services grows at 2.6% on 19.7% margin. The fast part is the thin part. A blended target was getting harder for reasons unrelated to how anyone runs the business. The second is what happened when Bank of America pushed on whether medium-term margin expectations still hold. Edgecliff Johnson didn't disagree. He called 2027 in North America a dislocation year. Investment landing before the revenue it buys. The target's gone. The expectation isn't. Now the number that explains why they wanted the room. North America operating profit rose $37 million. Net cost savings in the half were $28 million. Roughly 3/4 of the profit growth came out of the cost base, not the top line. Over 1,100 support and call center roles offshored. Over 500 roles taken out through automation and redesign. And here's an accounting point worth knowing, because it flatters the picture. The $38 million it costs to achieve those savings sit in one-off and adjusting items, outside adjusted operating profit. The savings land in the profit number. The cost of getting them doesn't. Another $32 million or so to come this year on the same basis. Not sharp practice, it's normal convention and clearly disclosed. But when you see 10.2% profit growth, know that the spending which produced it is on a different line. And there's tension in this too. Rentokil says leads aren't converting because of friction in onboarding, inspections, and scheduling. Their fix is adding lead coordinator roles. Having just moved 1,100 support and call center roles offshore, I'm not saying one caused the other. Different jobs and a company that size can do both sensibly. But it's the question I'd carry into my own business. Which of your costs are waste? And which are the customer experience wearing a cost center name badge? Here's my take. This is a company buying itself permission to spend. Keep a hard public number and you eventually choose between hitting it and making the investment. Drop the number and the choice disappears. Discipline or cover comes down to one thing. Does the volume line move in 2027? 14 acquisitions in the half, $37 million for about $26 million of revenue, roughly 1.4 times revenue. 2 of the 14 were in North America, combined revenue about $1 million, and they've cut the full-year M&A budget to around $120 million. The size isn't the interesting part, it's what they bought. Season 1, Episode 12 was about the density premium. Acquirers pay for concentration, not revenue. Customers you drop onto an existing route without needing the warehouse or the branch manager. Rentokil's own framework has 3 buckets: pest control bolt-on density building, hygiene and well-being bolt-ons, and capability extension, and cities of the future entry platforms in Asia, Latin America, and the Middle East. This half, the money didn't go where you would assume. 9 deals were pest for about $10 million of revenue. 5 were for hygiene and well-being for about $16 million. 5 deals out of 14 carried nearly 2/3 of the revenue bought. And hygiene and well-being is where Rentokil files capability extension. Their own examples are mold and medical gas. That's not density. That's buying a service line you didn't have. The business combinations note confirms it. 24 million of acquired intangibles this half, 15 million customer list, 9 million other intangibles. Same half last year, 19 million, all customer lists, nothing else. Customer lists are the density asset. That's the round on the map. Other intangibles are brands, technology, licenses. That line went from 0 to 9 million. Here's my take. They didn't just buy less. They bought differently. Capability, not density, in hygiene and well-being outside of North America, which is quietly remarkable given where the problem is. The North American pest business is growing at 1/3 of market rate and received 2 deals worth $1 million between them. And the deals were about capability, not density. For you, 3 things. If you're building density, the biggest strategic buyer in the US isn't bidding on the round next door right now, and that has a time limit on it. If you're selling inside 18 months, one bidder has left the room and the rest can read these results too. And if what you own is a capability rather than a route, mold, wildlife, fumigation, specialist work, you're in the bucket still being funded, just not with a US check. Rentokil has about 660,000 PestConnect devices across roughly 40,000 sites. In the United States, just over 12,000 devices at 245 sites. Under 2% of the fleet in the largest market on earth. They only launched properly this half, so that's the starting line, not a failure. Now, the number I found most interesting in small type on a customer focus slide, which no analyst asked about. UK commercial retention on connected accounts, 87.5%. On non-connected, 84.7%. For context, Anticimex have claimed something similar for years through EQT, their owner. Contracts are around 30% larger and cancellation rates about half those of traditional pest control. Rentokil figures work out an 18% reduction in churn. Anticimex claim 50%. Different sources, different populations, and I can't adjudicate between them. But go back to Rentokil's annual report before you take any of it on face value. Most commercial customers contract annually. PestConnect customers in the largest markets typically sign 3-year contracts. And remember how retention is measured. Portfolio value against opening portfolio. A customer 2 years into a 3-year term largely can't leave. So a meaningful part of that 2.8 points isn't satisfaction, it's contract length. And look at what Anticimex say along their numbers. Contracts 30% larger. Same pattern from both. Here's my take, and it's a better lesson than the one I went looking for. The device isn't what holds the customer. The commercial terms are. The device is what makes those terms saleable. Nobody signs 3 years for a quarterly service visit. They'll sign 3 years for a system that's installed, mapped, alarmed, and would have to be pulled out and replaced. That's Season 1, Episode 11, upgrading the commercial contract, showing up in 2 companies' published numbers. So the read across isn't buy sensors and retention improves. It's by sensors, so you can change what's in the contract, then sell the term and the price. Another $47 million of provision this half. Total termite provision now $392 million, of which $364 million is legacy. Terminix customers on contracts Rentokil describes as predominantly unlimited liability. They settled $46 million in cash in 6 months, guiding $115 to $125 million for the year. And the direction is wrong. Litigated claim rates up 11% over the half, on top of 75% across 2025. Non-litigated rates up 6%. Cost per non-litigated claim up 8%. Contracts written after January 2023 carry a $250,000 cap. Rentokil didn't write those warranties. They bought them, and they're paying over $100 million a year for the privilege. Pull your own damage warranty wording this week and find out whether there's a cap on it. That clause is the difference between a bad year and the end of your business. Second, and credit to Rentokil for publishing it. Net promoter scores across the top 20 pest markets range from about 36.9 to about 86.4. Same company, same service, 50 points of spread. Edgecliff Johnson said the same thing about American branches. Top third growing well ahead of market, bottom third holding the company back. His explanation was blunt. We don't have a standardized operating model. Here's my take. Variance is the enemy. The gap between your best branch and your worst is worth more to you than any new market you could open this year. 2 episodes ago, I covered Rollins' soft residential quarter. They put it down to consumer demand going quiet, and I said the test was what happened at Terminix over the same 3 months. The answer is more useful than either option I offered. At Rollins, the weakness wasn't residential as a segment. It was brands inside it. Their words, softness concentrated in brands like Orkin that depend on search and inbound consumer calls. Over the same 3 months, Home Team selling through builders grew double digits. Fox, selling door-to-door, posted high teens. Now Rentokil, residential leads up 6%, and regional brand lead flow up double digits. Then an analyst from Rothschild asked about the late quarter softness, and Edgecliff Johnson said it tends to be more in our national brands than in our regional brands. That's Rollins' sentence in a different accent. Here's my take. Demand didn't go away. Demand moved channel. That's a far better problem to have. If consumers stopped needing pest control, nobody could do anything. If search delivers less while builders door-to-door and local brands deliver more, that's a routing problem for your marketing budget. You can fix a routing problem. Rentokil got there first, incidentally. Door-to-door residential across 25 territories last peak season, extending to about 40 this year. Rentokil doesn't publish residential organic growth, so I'm putting their lead data next to Rollins' revenue data. And one thing I can't reconcile. Rollins' termite line grew 8.9%, while Rentokil's termite softened on housing turnover. And Rentokil is the more termite-weighted of the two. I'd rather say I don't know than invent an explanation. There are 3 things to do with this. 1. Recalculate your retention by portfolio value rather than customer count. If you've been backfilling bigger accounts with smaller ones, those numbers disagree, and the second is the true one. 2. Split your growth into rate and stops. If your stop count is flat, you're not growing. You're managing a decline with a price increase. That's exactly where the biggest company in this industry currently is. 3. Score your inbound leads before you call them. Rentokil built a tool that ranks leads on likelihood to convert and lifetime value. France, then Portugal and Switzerland, now piloting in North America. In Spain, proactive sales went from about 7% of sales in 2024 to about 44% this year. Cheapest AI in this industry, and it needs no capital. Rentokil walked away from a target that it was about to hit, because hitting it wouldn't have fixed the actual problem. The problem is that 4 years after the biggest deal this industry has ever done, the recurring book in the biggest market on earth isn't growing in stops. Everything else in this release is a consequence of that and an attempt to fix it. In fairness, this is a company that published a 50-point spread in its own satisfaction scores, told the market its bottom third of branches is holding it back, and put in writing that it hasn't set its own front line up for success. That's not a company hiding. Knowing isn't fixing. Duffy said himself on that call. 2 years. Next episode, all three side by side. Rollins, Ecolab, Rentokil. Same quarter, 3 different problems, 3 different ways of making the growth look better than it is. I'm going to rank them, and one of the results will annoy somebody. Thanks for listening. If this was useful, send it to someone who will argue with me about it.